Okay guys, coming to next standard. Index 115. Okay. Alaknand is engaged in the manufacturing and selling of a designer furniture. It sells goods and extended credit. Sir, one more point. For 115, please go to previous marathon. So we already discussed this marathon. I mean this topic in that marathon. So please go through that. I already uploaded in my Telegram channel. Please go through that. Okay. Clear. So I am not able to cover in this marathon because of lack of time. So don't mind for that. Okay. It also sells an extended credit. Alaknanda Limited sold furniture for 80 lakhs. Okay, selling furniture for 80 lakhs, that's okay, to a customer on 1423. The payment against which was receivable after 12 months. So the payment we are getting after 1 year only, after 12 months at the rate of interest 3% per annum. So basically what is the selling amount? 80 lakhs into 3% is the interest amount. So total 80 lakhs plus 24, 2,40,000, total 82,40,000. That is the total amount we need to receive after 1 year, correct? So but today we need to recognize that cost price, nothing but cash price, right? Yes or no? Yes, please bring it to the present value. At the interest rate is the 8%. So 1 by 82 lakhs 40,000 divided by 1.08. How much? 76,29629.6. Correct or not? So this is the calculation. 82 lakh 40,000 divided by 1.08. Present value. I'm bringing it into the present value. Understood? Okay. So the value is 76 lakhs 29,000. 630. Okay, so then what is the interest income? Basically interest income will be calculated on this amount only, correct or not? So into 8%, simply we can calculate how much. 610370. Sir, no, index 109, sir, we have a lot of problems we have discussed, right? So what is the amount? 6,10,370. that is the interest income. Simple question, right? Yes, very simple question, guys. Next, name Tulsi Limited, a firm of contractors provide the following. Yes, guys, for this this question, I want to discuss a few things regarding Index 115. See, please remember these things, guys. As per Index 115, it's nothing but construction contracts. I'm talking about construction contracts topic. Okay, see, guys. In this case, first of all, we need to check what is the contract price. Nothing but it is the contract revenue. Next, please check contract cost. Contract cost means total cost. Okay, total cost we are going to incur. We need to identify that also. The difference between these two is nothing but profit or a loss. Correct or not? Contract revenue minus contract cost equal to, if it is positive, then contract profit. Otherwise, it's a contract loss. Correct? Yes. See, basically contract may complete in more than 1 year. Generally, correct or not? Suppose example, construction of a building. Okay, so we are constructing almost 50 floors example. Okay, so it will take almost 4 to 5 hours. Assume that 4 to 5 hours. 5 hours, not years. Okay, clear. See, now initially I can expect suppose example, I given this contract to particular builder. Okay, he will tell us the what is the contract price. He will tell us. Okay, in that only he will incur the contract cost. Correct or not? Yes or no? Okay, so this is completely, this stand is applicable to builder, guys. I'm talking about builder because he is only getting the revenue, right? He's only getting the revenue. So that's why this stand applicable to builder. Understood or not? Yes. So in this case, basically we need to find out the profit for each year, guys. Suppose example, if it is the contract is for 3 years, so we need to calculate the profit or loss for each year. Correct or not? Yes. So that's why we need to find out the percentage of completion here. For every year, we need to find out the percentage of completion. How much percentage of work have been completed? So we need to find out that. Okay. So simple, guys. Okay, so please come to concept, guys. So this is the construction contracts. So this is of two types, basically fixed price method and cost plus contract, nothing but. Okay, cost plus means some profit will be added to the cost. Correct or not? Yes. Fixed price means initially fixed one particular price. Okay, that is called fixed price. Okay, so we need to calculate the percentage of completion in this case. For that purpose, what is the formula? So cost up to date divided by total estimated cost into 100. What is that? What's the meaning of cost up to date? Up to date means up to date. Suppose example, first year I have incurred 10 lakhs. That is the cost up to date divided by total estimated cost, which means in the next year also, next 2 years. Suppose example, if the contract is 3 years, I I can expect I need to expect whatever the cost I'm going to incur in next 2 years also. So inclusive of all the cost is nothing but total estimated cost. Okay, I will give an example, don't worry. So cost up, suppose example, first year expenses you have incurred 10 lakhs. In the next years you are going to incur another 20 lakhs. Total cost how much? 30 lakhs, because current year 10 lakhs and next year 20 lakhs, total 30 lakhs into 100. This is the calculation for, what is that? What is that, guys? Percentage of completion. What do you mean by cost up to date? What do you mean by cost up to date? So work certified plus works uncertified. Basically, whatever the work the builder had done, which has been certified by the architect or something, okay, or engineer or architect. So that is nothing but work certified. So whatever the cost you have incurred, whatever the work you have done, some of the work may not be certified by the architect or an engineer. Okay, so that is nothing but works uncertified. So, but at any cost, whatever you have incurred the both the cost, right? That's why cost up to date equal to work certified plus works uncertified. You already incurred the cost, but some of the work is not certified. That's it. So, but you have incurred the cost, right? So that's why cost up to date equal to work certified plus works uncertified. And one more point: if any material unused in current year, if any material unused in current year, it should be reduced from cost. It should be reduced from cost. Yes. What is the meaning of it, sir? Suppose example, I have purchased 10,000 value of a material, but I am not using 5,000 value of material. Then how can I consider in current year cost? So that's why that should be excluded. Correct. Suppose example, material cost is 10 lakhs, but 5 lakhs value of material is not used in current year. So current year cost how much? 5 lakhs only. That's it. Example, contract price equal to 10 crores, contract cost equal to 8 crores, contract profit is 2 crores. Suppose example, if it is a 1 year contract. If it is more than 1 year, we'll discuss now. See guys, contract price equal to 10 crores, contract cost equal to 12 crores, cost up to date equal to 4 crores. Okay, see, please understand, try to understand this question. Contract price equal to 10 crores, estimated total cost equal to 12 crores, cost up to date nothing but current year cost equal to 4 crores. This is the question. First of all, you need to calculate the percentage of completion. So percentage of completion equal to cost up to date divided by total estimated cost. How much? 4 divided by 12 into 100. How much? 33.333%. Yes or no? Yes. Okay. And immediately you need to find out what is the expected loss you are going to incur. So you need to find out that. How to find out that? Simply contract revenue minus contract cost. What do you mean by contract revenue? Contract revenue is nothing but contract price only. Sometimes the contract price may be changed also. Okay, so I will discuss it later. See here, the contract price is 10 crores, contract cost equal to 12 crores, the loss is 2 crores. So my expectation is 2 crores. That should be recognized immediately. This is the first point you need to write. Understood or not? Yes or no? Suppose example, if you want to find out current year profit, how to find out the current year profit? This is total loss, or current year profit or loss. This is total loss is 2 crores. That's okay. I want current year loss. How to find out that? Simple, sir. Current year revenue equal to how much? Total revenue equal to 10 crores, right? Proportionately, you can take the revenue also. What is the percentage of completion? 33.33. So 10 into 33.33%, which means 3.33 crores. That is the contract revenue. What is the contract cost? 4 crores. So how much? 3.33 minus 4. How much? 0.67 is the loss. Current year loss is 0.67. Future loss is minus 2. How much? How much? Sorry, 2 minus 0.67. 1.33. This is the future loss. But total loss is 2 lakhs. Understood or not? Total loss is 2 lakhs. Sorry, 2 crores. Initially, we already recognized that. Okay. But in the 2 crores, 0.33. 0.67. So 0.67 is the current year loss and balance is the future loss. That's it. That's you have to mention there. Clear? Okay. Clear. Sometimes in the given question, work certified and works uncertified will be given. So please identify that. So cost up to date directly may not be given. So you need to identify that. That's it. Okay. So basically, once you are done some of the work, okay, you will get the money from the particular owner. Okay, on proportionate basis, guys. Money also you are getting proportionate base only, but suppose example for first year you need to get 10 lakhs. Out of the 10 lakhs he will hold suppose example 1 lakh or 1.5 lakh something, some nominal amount will be holded by the owner, because nothing but customer. Owner means customer, he's customer to us, right? So because of for example some damages may be done in that, but during construction some damages may be there, right? So we don't know. So for that purpose, he will retain some money. Customer will retain some money. That is called retention money. Okay, we will receive the payments on progressive basis. That's why we can say payments received word will be seen in the questions also. Clear? Okay, that's it. That is more than enough. And one more point, escalation point I need to discuss here. Escalation means basically initially we came to agreement at a fixed price, but in future time, so due to maybe inflation or whatever, market price maybe changes, sometimes the prices may got increases. So in that case we don't know, correct? So for that purpose, during when we are entering into agreement, we need to note down that escalation clause should be there, which means if anything is increased during in a latter point of time, then we need to consider that escalation clause percentage also. Suppose example it may be 5% or 10%, whatever. Okay, based on the situation we can increase that contract price as well, the contract cost also. Clear or not? Yes, just common sense. So here escalation cost increased by, okay, see, basically in the given question, escalation in cost by 5%, accordingly the cost price is increased by 5%. Okay, so see guys, when the contract price is increased, so in this case what is the contract price? Fixed price contract price with the escalation clause is 1000, right? The escalation clause is there, so we need to apply this percentage for that escalation, sorry, contract price. How much? 1000 plus 5%, 1050, correct? Yes, sorry guys. See, in this case the contract price will be increased by 50, right? So total 1050, correct or not? Yes, 1050. Now I want to find out the total estimated cost, because the question is asking about what is the calculated the expected loss to be recognized immediately as per Ind AS 115. So you need to find out the expected loss, total expected loss. So as of now you need to find out the total estimated cost, because we have already contract price is there. How much? 1050. See guys, in case of a contract cost, no need to add 5%, because which means it includes 5%. So please remember that. Okay, so in that way, can you please calculate that cost up to date? So first of all, please calculate the percentage of completion. Percentage of completion. The question is not asking about the percentage of completion, but please find out. Work certified, how much here? 500. Next, works uncertified 109. Out of that, 75 lakhs metal issued out of metal unused at the end of the period is 4 lakhs, which means 75 lakhs metal is there. Out of that, 4 lakhs is not using in current year, so you need to minus that. So minus 4, which means 105. So 500 plus 105, how much? 605. 605 plus estimated further cost of completion, which means in future cost, how much? 495. So total 1100, correct? 605 plus 495, 1100. That is the estimated total cost, correct or not? So contract price is 1050. Contract price is 1050. Cost is 1100. So 1050 minus 1100, how much? 50 is the loss, correct? So option A is the answer, guys. So please change this. Please change this. Option A is the solution. Clear? So this is the question they're asking. If they ask about percentage of completion, how to find out the percentage of completion, guys? Cost up to date, how much? 500 plus 105, how much? 605 divided by 1100. How much? 605 divided by 1100 into 150, 5%. Clear or not? If the question is asking about current year profit or loss, you can find out easily based on this. Okay, simple kada? Yes, okay. Next, coming to next point. On 1/8/2021, A entered into contract with the hotel for a daily sanitation of the building for 3 years at a 12,000 per month. Okay, every month 12,000. The customer receives and consumes benefits every day, each day. Determine the revenue to be recognized 21/22. So per month is 12,000. So it is started on 1/8/2021. They're asking about 21/22. How many months we have in that particular year? 8 means April, May, June, July. So 4 months gone. So how many months remaining? 8 months. So 8 months into 12,000. Total 96,000 is the revenue to be recognized. That's it. Very simple, guys. Next, coming to valuation of a shares. So there are the main 3 major approaches we have: income approach, net asset approach, market approach. All of the above. So major base of the asset valuation for a going concern is, what is it? Book value, net replacement value, net realizable value. So you can check the theory also. Next, the income approach for valuation shares includes the model or techniques. Discount cash model is there. Next, dividend discount model is there. Maintainable profit basis also there. So all of the above. Some of the valuation of goodwills: calculation method, super profit method, average profit maintenance method. So total all of the above. Same questions. Bacha questions. The way to determine the value of goodwill is in the calculation approach. Calculation of average profit, calculation of super profit. Yes, both are there. Yes, both 1 and 2. The major asset base of asset valuation for a going concern is, yes, this is the repeated question. Okay, capital employed equal to 255. Average annual profits is 57 lakhs. Normal rate of return to 12%. Value of goodwill on the base of calculation of super profits. So can you please tell me, guys, calculation of super profit? In that case, what is the formula? Super profit by NRR. So what is super profit? How to calculate that? Average profit minus normal profit. What is the average profit here? It is given already. How much? 57. Normal profit equal to capital employed into NRR. How much? 255 into how much? 12%. 30.6. So 57. How much, guys? 26.4. That is the super profit divided by, what is the NRR? 12%. So 220, correct? So 26.4 divided by NRR percentage, 12%. Correct or not? Yes, that's it. Simple formula, sir. You need to apply. That's it. Okay, a firm values goodwill under calculation of profit. But the average profit of the firm is 4 years has been determined 1 lakh. Before tax, capital employed in the business is 4 lakh 80, and its normal rate of return is 12%. Tax rate average 28% on average. Value of goodwill based on the calculation of average profit. Can you please tell me in case of average profit? Average profit divided by NRR minus actual capital employed. Correct? So what is average profit here? Average profit is 1 lakh. 1 lakh divided by NRR, how much? 12%. So 1 lakh divided by 12%, how much? 8,33,333 minus, next, actual capital employed, how much, guys? Actual capital employed, sorry. Yeah, sorry guys, the given profit is before tax, but we want after tax, right? First of all, please reduce the tax percentage. So 1 lakh minus 28%, 72,000, correct? 72,000 divided by NRR. Average profit by NRR, how much? 12%. So divided by 12%, how much? 6 lakhs minus 4 lakh 80. How much? 6 lakhs minus 4 lakh 80, 1 lakh 20,000. That's it. So please don't forget after tax only, not before tax. From the following particulars, you are required to calculate the value of the goodwill as per super profit. 4,50,000 computed. Normal rate, present value of annuity 12%, 3.3074. Yes, it's a bacha question. Directly you can calculate. Correct or not? Yes. In case of a annuity method, what is the formula? Super profit into present value of annuity figure. So super profit how much? 4,50,000 into 3.0374. 13,66,830. Basic question. Next, super profit equal to average profit minus normal profit. Correct? Yes. We already know about it. We can also say that average profit is nothing but future maintainable profit. Okay. Normal dividend expected on equity shares is 8%. The profit available to equity shareholders is 3,83,125. And value of net assets for the equity shareholders is 40,80,000. Calculate the value of each equity share under fair value method if the number of outstanding shares is 1 lakh and the face value is 10 rupees. So, very simple question, guys. Okay, the question is asking about fair value method. Fair value method equal to basically what is the formula, guys? Value per share as per net assets method as well as the next second one dividend yield method, right? Divided by 2. Correct or not? Yes or no? Yes. So that's why first of all find out as per net assets method value per share as per net assets method. What is the formula? Net assets by number of shares. What is the net assets, guys? 40,82,000 by 1 lakh. How much? 40.82. Next, coming to next yield method. So under yield method, what is the formula? When we have a profit divided by number of shares into normal rate of dividend. So what is the amount? 383,125 divided by 1 lakh shares into 8%. How much, guys? 383,125 divided by 8,000. 47.89, correct? 47.89. Average of these two is nothing but fair value method. Say yes or no? Yes, 40.82 divided by 2, 44.36. Yes, option A is the answer. Simple, guys, simple. Please remember the formulas. Net assets by number of shares is the first method. Second method, yield method, is profit by number of shares into NRR. Okay, yes. If you want, you can see the formulas also. So here we have a formula. Yes, you can note down. Actually, in this marathon, I did not discuss about I have not discussed about this topic, but still it is in our previous marathon. You can go and check. Okay, clear? Yes. Come to next question. The value of share under the net assets approach is determined by accessible net assets to equity shareholders or debentures or preference shareholders. Obviously, equity owners only. Yes, we know that. Next, net asset value method is based on the assumption that the company is going concern or going to be liquidated. Can you please tell me, guys? Going concern or going to be liquidated? Say yes or no. Which one? Which method? Guys, basically it is based on going concern only, not going to be liquidated. So in some scenarios it may be used, but majority of the cases going concern only will be there. Nothing but the assumption is going concern assumption only. Okay, so please go through that only, don't worry. Next, coming to the following details of XYZ. Average profit for 4 years is 7 lakhs. Average capital employed is 55 lakhs. Normal rate of return 10%. Present value of annuity 3.1699. Determine the value of goodwill based on the annuity of super profit. So please tell me what is the super profit, guys? Super profit equal to average profit minus normal profit. Average profit how much? 7 lakhs minus normal profit means capital employed into NRR. Correct? Capital employed into NRR. See how much? 55 lakhs into 10%, 5 lakh 50. 7 lakhs minus 5 lakh 50, 1 lakh 50,000. Okay, 3.1699, 475, 485. Correct? Obviously. Same question, kada? We already discussed in question number 1 or 2, right? Same question. I don't want to discuss here. Yeah, this is the basic question, year profit. So directly you can easily calculate the average profit. Okay, weighted average means we need to give the weights. 1, 2, 3, 4, 5 weights should be given. Okay, so what is the formula? Weighted average profit into goodwill equal to formula. Weighted average profit into number of years of purchase. Number of years of purchase already given in the question, so directly we can calculate. So I don't want to discuss this basic bacha question. So next, Nupur has equity share capital of 30 lakhs consisting of fully paid equity shares of rupees 10 each. Net profit for the year is 45 lakhs. It was also issued 27,000 10% convertible debentures of rupees 50,000 each. Sorry, 50 rupees each. Each debenture is converted into 5 equity shares. The applicable tax rate 30%. Compute diluted earnings. So basically diluted earnings means this is as per EPS, guys. EPS means 33. Okay, so what is that? 33 means earnings per share. That's topic only, so that is not there for us, so don't worry about it. Next, income approach for valuation of shares includes the techniques. Yes, repeated question. Next, coming to question number 19. So this is also basic question, already computed, calculated. Okay, same question repeated. Sorry guys, repeated questions. Okay, next, coming to accounting for financial instruments. Okay, for this also we can go through previous marathon only, India's 32-109. So we have only 2 or 3 questions we have discussed, or otherwise I will upload one more, I mean previous video I will upload again, so please go and watch. Okay. Indian accounting stands for recognition, measurement, disclosure of financial instruments. Yes. Presentation 32, disclosure 107, financial instruments 109. Nothing but recognition and measurement. Okay, so please remember all these things. Recognition and measurement means 109. Okay, presentation 32, next disclosure 107. So 3 standards include in that. Next, cash is a contract evidence, residual interest. Residual means remaining, nothing but it is remaining shareholding, everything goes to equity shareholders, right? So which is nothing but equity instruments. Equity instruments, yes. After deduction of all its liabilities from assets, then the difference is nothing but equity instruments. Yes, we can say that directly. India's 109 deals with the deals with the recognition measurement of financial instruments and hedge accounting. Okay. Ex Limited grant a loan to Y Limited for 40 lakhs repayable in 2 years. This is the question directly given in the, in our material. So this is not a simple question, guys, but simply we can calculate. See, for this purpose, we should know some concept. I will show you. In case of a financial liability, basically, in case of a financial asset or a financial liability, in the given question, it is a financial asset or financial liability. We are granting a loan, which is asset, right? So financial asset, go to financial asset concept. So in case of a financial asset, if there is any transaction cost, that should be added to the fair value. So please remember that. In case of a what is it? In case of a financial asset under AMC method, amortized cost method, this is FET OCA, this is FET PL. I think everyone knows about it, these basic things, right? So in this scenario, if there is any transaction cost, that should be added to the fair value. So please remember that. That is only the point which is required to us in this question. Okay, so initially granted loan 40 lakhs, which is repayable in 2 years of rupees 46. Okay, however, due to economic recession after 1 year, the repayable amount has been revised to 44 lakhs. That's okay. Effective interest rate is 6%. The loan processing cost was 2 lakhs. So executive accountant suggested to compute the amount to be charged as processing cost for the first year in the P&L. Say yes or no. So basically, if there is any processing cost or transaction cost, that should not be transferred to P&L, that should be added to the fair value. So that's why the loan amount should be 40 plus 2 lakhs, total 42 lakhs. Correct or not? Yes. So the question is asking about suggested to compute the amount to be charged as a processing cost to the first year in the P&L. Say yes or no. No, actually it's wrong answer. So he should ask about the loan amount. That should be 42 lakhs only. Okay. Clear or not? That should be added to the loan amount simply. That's the point I want to discuss here. This is when you're granting a loan, it's a financial asset, right? If you're taking a loan, it's a financial liability. In that case, the transaction cost should be minus, reduced. Not in all the cases, guys. In case of financial liability, if it is amortized cost method, then transaction cost should be reduced from the loan amount. Okay, liability amount. Simple. But in case of FTPL, not required. Directly you can recognize it at fair value only. Clear or not? Yes. Okay. So again, same question. Okay. Next, financial assets are cash, equity instead of another entity. It's a contractual right. Yes, all of these. Next, in this 109, classify the financial assets and financial liabilities into following categories for recognition and measurement. Just now we have seen that fair value through OCA, amortized cost, fair value through P&L. In this one, similar repeated questions, guys. Yeah. See, which objective of holding does not include collection of cash flows or by selling of financial assets? So this point is not involved in amortized cost method, correct? It is involved in FET OCA, correct or not? FET OCA and FET P&L, correct or not? So it is not included in amortized cost method. Yes or no? Only to basically collection will be there, but not by selling of financial assets. Okay. When you're selling means it is not comes under amortized cost. Okay, this is already covered in our index 32. So please go to the marathon, guys. Don't worry. Next, which is not true. Equity instrument is evidence residual interest in the asset of entity after reduction of all its liabilities. Yes, that's okay. Putable instruments is a financial instrument that gives holder the right to put the instrument back to the issuer for cash. And yes, this is the same. This is also okay. and none of the above. Cash, equity instrument of another entity, contractual rate, or financial assets. Yes. So please read this, guys. This is sometimes they will ask for theory also. Okay, I have given in my Telegram channel. Please go through that. What are the theory questions I have given? Please must read that. That's it. Okay, Index 109. Why they are repeating the questions, guys? Sorry. Yeah, coming to NBFC. NPA in case of a lease rentals and hire purchase sets. If overdue for 3 months as on 31st March 2016, overdue for 6 months on 31st March 2017, overdue for 3 months on 31st March 2017 onwards. Yes, everything is correct. That's why all of this. Understood? So basically they are reducing the number of months year by year. That's it. Okay, the term public funds includes debentures, funds directly or indirectly through public deposits or bank finance. All of these. Yes, NBFs applicable from 1/4/2018. Yes, we know that. Next, all NBFC non-deposits which have assets size 500 crores and above, and all NBFCs shall maintain tier 1 capital of how much percentage? 10%. Okay, please remember that lease rental hire purchase will be treated as non-performing assets in case on 31st March 2024 is overdue. As of now, 3 months only. Okay, as of now, 3 months only. Overdue by 3 months, it's an NPA. That's it. Okay, so I will discuss about this percentage, guys. Percentages. So maximum whatever I want, I'm going to discuss. So please don't mind. I want to make simple, guys. Okay, so this is the provision percentages, guys. In case of unsecured doubtful, sorry. Provision requirements for standard assets. Yeah. Okay. Coming to standard, if it is systematically important, then 0.4%. If it is not systematically important, then 0.25% only. Okay, systematically important means asset size should be more than or equal to 500 crores. Non-systematically important means less than 500 crores asset size. Okay, in case of substandard, 10% is the provision. In case of a doubtful, unsecured is 100% only. If it is secured up to 1 year, 20%, 1 to 3 years, 30%, more than 3 years, 50%. Okay, now in case of a loss assets, 100%. Loss assets, 100%. Okay, please remember all this. Last time we got 7 marks question from this, so this time we may not expect, but for MCQ purpose, please remember. That's it. Okay, and they may ask a question from these guys. Please study this. Additional provision may be created based on the net book value. Up to 12 months nil, 12 to 24 10%, more than 24 up to 36 months 40%, next 36 to 48 70%, more than 48 100% of net book value. So please remember this, very important for this attempt. Okay, so you can solve that question as now. Okay, now coming to business combination. So I have discussed a lot of examples during my marathon part 2, right? Yes, so I have discussed almost number of examples regarding calculation of NCA, calculation of goodwill, okay, calculation of capital reserve, gain on bargain purchase, nothing but calculation of purchase consideration, everything will be covered here only. Okay, question number 1, 2, 3. Okay, I don't want to discuss here also. If you have any special question, I will discuss. That's it. Okay, these are the basic questions, guys, basically. Okay, so this is the formula for goodwill. Okay, see, PC plus NCA minus net assets. We already know about it. So see, this is the questions directly given in the material, guys. So directly material questions given as MCQs. Okay, these are the direct material questions. If you want, you can go and check there. Okay, so I will discuss this question number 8 and 9. Okay, so coming to this concept, basically the 2 questions based on change in proportion of NCA concept, guys. First of all, I want to discuss about this this concept, and later we'll go to the questions. Easily you can solve it. So parent ownership interest may change without the loss of control. Suppose example, I have a 90% of a control, okay, in particular company A Limited. So I am selling 10% of the stake. So even if the control is losing or not, no, there is no losing of control, but NCA value will get increased. So initially I have 90% stake, and later I sold 10%. So then my stake is 80% only. Then NCA value will get increased. NCA percentage is how much? 20%. So in this case, what should we have to do? That's the question. So see guys, if NCA increases, then NCA value will get increases, right? So it should be credit. If NCA value decreases, suppose example, if you purchased, then NCA value will get a decrease. So it should be debited, because basically NCA should be shown under liabilities only, right? So if it is increases, then you can credit. If it is decreases, you can debit that. See, the point is control should not lose. Okay, if we lose the control, then it will go to another concept. Okay, so see, parent buy shares from NCA. Okay, 60 to 70%. It was increased from 60 to 70. So there is no loss of control. Yes, okay. Parent sell shares to NCA 70 to 60. Okay. Subsidiary company new shares to NCA, resulting dilution of stake of parent. Suppose example, initially I have a 70% stake holding. Total shares is 10 lakhs. Out of 10 lakhs, I have 7 lakh shares. Now company issued fresh shares. Suppose example, 1 lakh extra shares are issuing to NCA, not for me. So then the stake of mine will get decreased, correct or not? Still the control will not lose. Yes, this concept will be applied. See, this example, P Limited sold 20% for 100 lakhs to outsider in cash, wholly owned subsidiary. Nothing but I have 100% holding, out of that I am selling 20%. So carrying value of subsidiary net assets is 300 lakhs. So this company net assets is 300 lakhs, including goodwill is 65 lakhs. Okay. See, now what should I need to do? Can you please tell me? So this is the entry, guys. Basically, I'm selling, right? I'm getting cash 100 lakhs. So cash account debit to NCA. NCA value will get increased. How much? 20% I'm selling, right? So NCA will get created now. So out of, for example, basically in this question, I'm following proportionate net assets method. Proportionate net assets method. India's 103, correct or not? Yes. So 300 into 20% 60. So the balance will be gain. Nothing but other equity. It should be recognized in other equity. This is the gain. The same way, Gold Limited holds 75%. Gold Limited have 75% on in Gold Limited. Okay. Coal Limited. Fair value of net assets of Coal Limited is 10 lakhs. Okay. So 1/4/2022, 31st March 2021, total controlling interest they got 2 lakhs. This is additional thing. Same question, guys. Same question. I already told you. So Gold Limited acquired 75% stake for 10 lakh 80,000. Fair value of the net assets is 10 lakhs. During 1/4/2022, that is 23, they made OCA. Coal made OCA balance how much? 2 lakhs. 31st March 2023, Gold Limited purchased 50% from outsiders for rupees 2,20,000. Calculate NCA proportionate net assets value. Proportionate net assets value. You need to find out the NCA value. Simple, guys. Okay. So go to solutions. Okay. So as of now, the fair value of net assets is 10 lakhs. That's okay. So I'm going to find NCA value based on net assets method only. Okay. See, first of all, I'm selling 15% holding, right? 15% holding. Okay. So basically the fair value of net assets is 10 lakhs only. Additionally, in that 1 year, so the controlling interest how much? Comprehensive income how much? 2 lakhs. Nothing but comprehensive income how much, guys? 2 lakhs. Total will get 12 lakhs. Out of the 12 lakhs, I'm selling 15%. How much? 1,80,000. I'm selling 1,80,000 value. That is nothing but NCA value only. Correct? But I'm getting how much amount? 2,20,000. I'm selling it for 2,20,000, but the value is 1,80,000 only. So the difference should be the profit. The question is asking about only NCA. So then 1,80,000 is the NCA value. In the similar way, you can find out the gain or loss. How much gain or loss? Please tell me. Okay, you are selling at 2,20,000, right? So not loss, guys. Loss or gain? What is the entry? Yes, gain only, obviously, not loss. Okay. So gain should be, please recognize in the books. That's it. So please change that. Okay, no? Please change that. So why the answer is wrongly entered in the material? Okay. Same question, right? Please check. Can you please check whether it is a similar question or not? Similar question, right? Okay. That's right. Yes, correct only. It's a profit only, not loss. Okay, I'm selling it 2 lakh 20. I'm getting one. I'm losing 1 lakh 80 value only. So option B. Okay, don't worry. Next. So this is already marathon. This is covered in marathon. Basic question. Next. This is also covered in marathon. Same question, guys. Same question. Yes or no? Yes. Basically, in case of a step up acquisition, okay, so we need to we need to remeasure the previously held investment. Suppose example, initially we have acquired 35%, right? So the value is 35,000 only. As of now, on acquisition date, the value of 35% is 45,000. So please remeasure at 45,000. The difference should be between these two should be recognized in P&L. So the question is asking about total amount transfer to P&L is how much? 10,000. Out of the 10,000 already some amount 7,000 is recognized in OC. So that is the second criteria. The question is asking about total amount should be transferred to P&L. How much? How much? 10,000. That's it. Okay. That is also covered. Next, yes, NCA value easily you can find out, guys. I don't want to discuss all this bloody. Similar question. Gain on bargain purchase. So 15th question. The pooling of interest is considered to involve which of the following? Assets and liabilities combined entities reflected as their carrying amounts. The assets and liabilities of combined entities are reflected at their net realizable value. Wrong. No adjustments made to reflect fair values and okay, wrong. No adjustments are made to reflect fair values. Yes, not wrong. It's correct only. So fair values will not recognize. We are not considering fair values, right? In case of a pooling interest method, common control. Say yes or no? Yes. So that's why they have given 1 and 3, both 1 and 3. How is NCA in the finance statements of the acquirer at the time of business combination? Please tell me, guys. It is shown as a liability only under other equity, correct? It is shows as item under other equity. After you have written the other equity, later that next you can write this NCA value. Okay, so already shown in the marathon also. Yes, you can check. Next, as per India's 103, business combination done under acquisition method. Yes, when after business combination acquire ceases to exist, it is to be recorded in the books of acquire in one set only in its standalone accounts. Which means if the acquire does not exist, you need to write only one set. That's why in the books of acquirer. India's 103 wider scope than AS14. Yes. So important, guys. 103 AS14 differences is very important for examination point of view. At what value NCA is recorded in the books? Same question repeated. Okay, not same question. We have two methods: fair value method, proportionate net assets method. India's funded states that acquire obtain control over acquire, recognize and measure the consolidated financial statements at the acquisition date. What value, guys? Identify assets acquired, liabilities at the fair value. Okay, NCA in the acquire at fair value or a proportionate value. Goodwill in the business combination, gain on bargain purchases. All these points is there. So all of the above. Extend to acquire 100% of the equity of by 31st March 23. The purchase consideration compress immediate payment. Yes, it's a similar question. I think so. Okay, 100 lakhs and 3 further payments of 5 lakhs. If the return on equity exceeds 20% each of the subsequent years, a risk adjusted discount rate is 20%. The total value of concession on the acquisition date is dash. See, guys, X is acquiring 100% of equity of Y. The purchase concession comprises immediate payment 100 lakhs. So immediate 100 lakhs plus 3 further payments of 5 lakhs. So at what rate? 20% discount rate. So please bring that 5 lakhs for a period of 3 years to the present value. So please calculate 5 divided by 1.2. How much? 10.5 plus 100. How many years? 3 subsequent years, right? Okay. Divided by 1. Please calculate. Simple, bring the 5 lakhs to the present value for a period of 3 years. 5 lakhs, 5 lakhs, 5 lakhs by using 20% discount rate. Okay, so 3 subsequent years, guys, which means next 3 years he is asking about, not other than first year. So the calculation is like that only. See, then 1 divided by 1.2 equal to m plus equal to m plus equal to m plus equal to m plus 4 times 1 divided by 1.2. So MRC, how much? 2.588, right? So 2.588 into 5. How much? 12.94 plus 100. Total 112.94. So we got this. Okay, subsequent 3 years means next 3 years, which means other than first year. So that's why we need to bring in the present value for a period of 4 years. That's it. See, one more point I found out. What is that? Yeah. What is this? See, guys. Yeah, I told you that gain of rupees 40,000, right? This is not gain loss only because it is purchase, not similar question. That's why I told you this is not similar to first question. Here selling, here purchasing. So please identify. Then we will get loss only because we are purchasing at 2,20,000. The value is 1,80,000 only. So then it is loss. Sorry for this, guys. Sorry for that. Okay. Next. Okay. Next again, basic question only. Similar to 22 and 24 is same. 22 and 24 is same. Okay, which of the following is false? So, as per India's 103, business combination and common control shall be accounted by using pooling interest method. Correct. India's 103, reporting business combination goodwill equal to consideration plus NCA minus net assets. Correct. NCA is recognized fair value proportionate net assets method. Yes, correct. All is correct. None of the above is false. Parent loses control of subsidiary, it shall de-recognize. So please remember all these points. So please go to the theory question I have given, or you can go to your material also, you will find out. Okay, in our material also we already given the loss of control conditions. Please go and read that and come to here and then answer, please. Okay. Next, again they are asking about gain on bargain purchase. Definitely this question will be there in exam, sure. Either goodwill or gain on bargain purchase or NCA calculation, whatever. Okay, clear? Okay, sorry guys. 27, okay, that is also basic question, I don't want to discuss that. Next, question number 28 also done, right? So India's 103 states that acquirer obtaining control over acquiry recognizes and measures in consolidated finance statements at the acquisition date. So all this done, right? So question number 29, 75% acquiring in R Limited, they paid 900 in cash for their interest. Pay value is given, assets and liabilities is separately given. So we need to find out net assets. How to find out net assets, guys? Net assets minus liability, simple. 2000 minus 920, that's it. The balance should be the net assets value, simple. So we can find out easily. Why I'm not discussing all this stuff? Because please, you also don't waste your time, guys, because we already learned in marathon. That's more than enough. Just apply that concept, that's it. Okay, next, question number 30. This is also basic question. On 31st March, A Limited absorbed B Limited. A Limited issued 60,000 equity shares that were trading at 25. 60,000 equity shares. 60, yeah, correct? Yes, at 25. The book value of the B's net assets is 12 lakhs. Equity share capital 5 lakhs plus other equity 7 lakhs. On March 31st, the fair value of net assets was B Limited was 13 lakhs. Compute purchase condition as per India's 103. Can you please tell me anyone? Please. 60,000 into 25, how much? 15. tax. That is only they are paying. They are asking about only purchase consideration. Okay. Those all are basic questions. This is also basic. Yeah, in business combination, control of business can be obtained by acquiring assets and liabilities, such as assets and liabilities must constitute business. Otherwise, it is not a business combination. Yes, correct only. Next, by acquisition of shares or by other legal process. Yes, that's okay. Why they are asking repeating questions here also? This is also repeating. Calculation of NCA. So I don't want to discuss all this stuff. See this 36. Car Limited absorbed Bar Limited and shares issued by Car Limited using swap ratio 3:7. For every 7 shares, they need to issue 3 shares. Okay. The intrinsic value of each Car Limited is 14 rupees. Bar Limited has 70,000 shares. So can you please tell me 70,000 into 7 by, sorry, for every 7 shares, we need to issue 3 shares, right? 70,000 into 3 by 7. How much? 30,000 shares into 14 is how much? 4,20,000. Correct? Yes. Understood or not? 70,000 into 3 by 7 into 14 rupees. That's it. It's very simple, guys. Next, again, this is also Bacha question. This is also repeated question. Common control transaction. Which method we need to apply? Pooling of interest method. So that is also repeated. Yeah, this is the exam question. Consolidated financial statements. Okay. We are done with Ind AS 103. That's more than enough. Whatever the points I have discussed during my marathon, so that is more than enough for MCQ purpose. For calculation of goodwill, NCA, gain on bargain purchase. Okay, gain on bargain purchase is nothing but capitalism only. Please don't get confused in that point. Understood or not? Yes. Okay, guys, this is Ind AS 103. So, and last and final topic we have. So, I'm not going to discuss all these theory, guys. Please go through all the theory MCQs. I don't want to discuss all this, but definitely we will get at least 5 marks from all these theory. So please read all the MCQs. Please don't leave, guys, anything. So I'm repeating, please don't leave not even one MCQ. Please go through all the theory. Just I will discuss CFS and Ind AS 28 MCQs only. CFS and Ind AS 111 MCQ also will be there in this. I think we have how many MCQs balance? So almost we have just only there is no numbering, 14, 15, yeah, 16, 17, 18 MCQs only there. So once we are done with 16 MCQs, this is more than enough for our exam. That's it. But don't forget about theory MCQs. That's it. And one more thing, I'm going to release one question for CFS. Please watch that video before going to exam. Yeah, either today night or tomorrow morning, whatever. It's completely your wish only. Okay. So very simple, guys. So yeah, coming to CFS, consolidated financial statements are required to be prepared as per by an Ind AS complied company if it holds shares in investee company. So they have given different points. Entitled 20% or more voting rates have significant influence. Okay, yes. Ind AS 28, entitling joint control over the investee company, entitling control over investee company subsidiary, or also subsidiary company as per Ind AS 1. See, guys, Ind AS 28 covers nothing but joint venture as well as associate company. Next, 110 will be applied for subsidiary companies. Yes. Okay. For example, I have a holding of 90% holding in particular B Limited company. Assume that. So B Limited is a subsidiary company. Yes, I need to consolidate that as per Ind AS 110 because it is a subsidiary company. So for example, I have 25% only associate company. Yes, I need to consolidate, but as per Ind AS 28. So all of these, when consolidated finance statements are prepared by the investor company shall also prepare individual standalone finance statements which are named as separate financial statements as per Ind AS 27. Yes, SFS, standard number Ind AS 27. Ind AS 28, what is that? Investment in associates or joint ventures, correct? Yes. Next, investment entity is the entity that obtain funds from one or more investors for the purpose of providing those investors with Investment management services, yes, it's reasonable. Commits to its investors or the business purpose is to invest funds solely for returns for capital appreciation, investment income, or both. Yes, that is also reasonable. Measures and evaluate the performance of substantially all of its investments at a fair value basis. So please read this MCQ, guys, all of these. Dash is contractually agreed share of control of an arrangement which exists only decisions about the relevant activities requires the unanimous consent of the parties sharing control. So dash is contractually agreed. So we have how many options here? They have given 4 options. So please go through that once again. So you need to, if you want to know about this, you need to go to Index 111. So please go to Index 111 theory. Then you can solve this MCQ. So see, guys, dash is the contractual agreed sharing of control of an arrangement which exists only when decisions about the relevant activities requires unanimous consent. Only it is possible in case of a joint control, guys. Joint control, that is, has a joint control of an arrangement or significant influence over another entity. Okay. Next, this type of joint arrangement, when the arrangement has been structured through a separate vehicle. So for this purpose, you need to study India's 111 compulsory, guys. Otherwise, you cannot answer this. So next, that has a control of another entity, investee as described in a paragraph 5 and 6 of India's 110 consolidated financial statements. This is not the correct answer. So I will show you, guys. I don't want to get confused in this case. Okay. Wait, guys. Where is India's 111? Yeah. Guys, I have given in my marathon material also. I think it is not in marathon material. I don't think so. But please go through this also. Please go through this, guys. Please don't forget, because I'm expecting this theory question for this attempt, because it was asked in previous attempts also. So please don't forget. Okay. So please go through this theory. Next, please read this non-applicability also. India's 112 non-applicability. Sometimes they're asking this also. In previous examination, they are asked this point. From this point, they are asked one point which is not covered. So that's why you need to study all these. Just give a single reading. That's it. For this and this also. So please go through this, and go through this. These 3 points. Please read, guys. India's 112. So please take a snapshot. I will keep it for 10 seconds. Please give it a screenshot and please read this. Okay, please pause the video and take the screenshot. And this one also. This one also. Please take a screenshot. Okay. Please read this also, guys. Please don't mind. Okay. Then only you can answer. So I want to solve only practical questions, guys. Practical questions, not theory questions. Theory questions, please read yourself. Okay. Coming to question number 11. I don't want to discuss all the theory questions. Okay. On 1/4/2022, Ganga Limited purchased 30% interest in Sagar Limited for 2,50,000. On the date, Sagar shareholders' equity was 5 lakhs. The carrying amount of a Sagar identifiable net assets was equal to book value. Ganga correctly reports a significant influence investment using equity method. Both the companies on 31st March, Sagar Limited reported net income is 1,50,000 and paid total dividend 40,000. So, guys, as per India's 28, what are the entries? Do you remember? First is the investment entry, right? So just wait. Okay, so come to journal entries for equity method, guys. So first entry, investment entry, guys. So investment in, suppose example, I invested in B Limited. So the entry is investment in B Limited to bank. Okay. Next, share of profit of the associates. In the given the question, in the given question, they will give the profit share also. So suppose the example profit amount is 1 lakh, your share is 25% only. So you need to consider only 25% of a profit only. So how much? 25,000. So please don't forget that. Okay. So investment in B limited to share in the profit of investee. Next, OCA balance. If the OCA balance similar case, investment in B limited to share in OCA of investee account. Okay. If you paid any dividend, then investment balance will get deducted. So then entry will be dividend receivable to investment in B limited. Nothing but if you receive any dividend, then investment amount should be deducted. That's it. Recording of dividend distributed by associate company. Associate company, if any dividend paid to you, then this is the entry, guys. Please don't forget. I think I'm expecting a question from this or MCQ, whatever. Okay. So every time they're asking a question from Index 28, so this question only they will ask. Investment in B limited, investment account debit to bank, investment to share of profits in investee, investment into share of OC in investee, and a dividend receivable to investment in B limited. Okay. Simple or not? Simple. They will give profits. They will give OCA. So because of that, investment value will get increases. Okay. If you received any dividend, because of that, investment value will get decreases. That's it. So then, so I have 30% interest. Total how much? 30% interest for 2,50,000 only. That is investment. Okay. Next. Reportable income how much? Total 1,15,000 to 30%. 1,15,000 to 30%. How much? 45,000. Dividend paid how much? Total dividend 40,000 into 30%. 12,000. How much? 2,83,000. Yes, option C. Simple, guys. You need to consider only 30%. This 30% value is 2,50,000. Don't calculate 2,50,000 to 30%, guys. The 30% value is directly given. So I am taking directly only 2,50,000. Next, 1,15,000 to 30% because it is the total income. Next, this is the total dividend. So I need to calculate only 30% only. That's it. Index 112 disclosure required to made about NCI. Some items of disclosure are given below. So please go through the theory, whatever I have told you before, and then come and answer. So option A, C, D to be disclosed. Nothing but A, C, D. These 3 points will be there in that theory also. Please go and read that. Next, on 1/4/2023, Rita Limited invested in the equity shares of Sita Limited at a cost of 2 lakhs. At a cost of 2 lakhs to acquire 25% the voting power, and Rita concluded that Sita is an associate of Rita Limited on 31st/24. Profit is 20,000, OCA 4,000, and declared dividend 8,000. So please tell me, guys, total 2 lakhs. Next out, 20,000 into how much percent is 25? 20,000 into 25%, how much? 5,000. Add 5,000. You need to add profit, add OCA also. OCA how much? 4,000 into 20%, 25%. 1,000. Next, 8,000 into 25%. 2,000. That should be deducted. Total 2,06,000 minus 2,000. 2,04,000. Yes, option D. Same question, guys. I don't want to discuss this. Next. Surendra Limited, a parent sold goods costing 400 lakhs to its 80% subsidiary. Narendra Limited 480 lakhs, 50% of these goods lying in the stock at 31st March 24. Narendra Limited has measured this inventory at a cost 240 lakhs. Tax rate is 30%. Deferred tax to be shown in the consolidated finance sheet is dash. Simple, guys. Surendra Limited, a parent, sold goods to costing for 400 lakhs to its 80% subsidiary in Narendra Limited for 480 lakhs. Cost is 400 only, but they sold goods at 480. Okay, they got profit 80. Okay, 50% of these goods lying in the stock at 31st March. So 50% of the goods out of 400, 200 stock lies with Narendra only. That is nothing but closing stock. Okay, Narendra has measured this inventory at cost 240 lakhs and the tax rate is 40%. So can you please tell me, guys? So how much? I think the value is 200 only, but they measured at 240. The difference is how much? 40 only. 40 into 30%, 12 lakhs. Option. So you need to calculate the deferred tax. Deferred tax, correct or not? Yes. See, for accounting, the cost is 200 only, but you have calculated at 240. Correct or not? Measured is inventory rate 240. Tax rate is 30%. So difference how much? 14 to 30%. 12 lakhs. That's it. Next, Mohan Limited held 50% of the voting power of Sohan Limited, which is a joint venture of Mohan Limited. The carrying value of the investment in Sohan Limited is 1 lakh 50. Out of 50% stake, Mohan Limited sells 20% stake in Sohan Limited to third party for concession 1 lakh 20. The fair value of the 30% retained is 1 lakh 80. Gain or loss are recorded in the Mohan in its P&L is dash. So tell me, guys. Mohan held 50% of voting power of Sohan Limited, which is a joint venture. Okay, 50-50 joint control they have. Carrying amount of the investment in Sohan Limited is 1 lakh 50. What's the carrying amount? 1 lakh 50. Out of the 50, we'll write this question. Right. Maximum. Thank you.